Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. Welcome to tax planning for the year end 2024. So this is going to be a 10-part video series. We're going to use the personal tax planning template, and this is going to be the last big video series of 2024. So let's go over a quick timeline of what's coming up over the next 6 months with me, with the YouTube channel, and with fulfilling our tax planning and tax return filing needs. So right now through December, we're going to work through the 10-part year-end tax planning series. There's a lot of things to talk about with respect to 2024. There's a lot of things to talk about regarding the new potential tax policies of the incoming Trump administration. So we're going to spend the next 4 or 5 weeks working through all of that. Then we're going to have our holiday break. We're going to get our eggnog. We're going to get our chestnuts roasting. Then starting January 15th and going through April 15th of next year, I'm going to be running a 2024 tax return preparation class. This is where all the action will be during the tax busy season. If you are interested in signing up for this class, you can use the link in the description below this video on YouTube. Alright, so with those housekeeping items out of the way, let's get started with 2024 year-end tax planning. And the first step will be to project our 2024 taxable income. Now, we need to know what our 2024 taxable income is projected to be so that we can then figure out, number one, what additional tax planning steps we need to take before the year is over. Number two, if we are sufficiently paid in through a combination of either withholding or estimated tax payments, so we can avoid getting dinged with that pesky interest and penalties. And then, of course, number three, what steps we should be considering for next year and beyond, particularly in light of the new Trump administration and the many different tax proposals that have been floated over the last several months. However, we should also note that the Trump administration tax proposals, whatever they may end up being, are not applicable to 2024. So the bulk of our 2024 tax planning is going to be based on existing law. And I want to emphasize that to drive home the point that while it's fun to speculate about what various tax laws may or may not become in the future, we don't want to lose focus on 2024 and potentially miss tax saving opportunities that are available in the current year. So with that said, let's jump into the personal tax planning template and get started. Alright, so we're in the personal tax planning template. I am right here on the main tab. We're going to start working in the 2024 column. For purposes of this base case scenario, we're going to assume that spouse number 1 is going to be 61 and spouse number 2 is going to be 60. And when we think about your current age, what are the main items that we should be considering? Well, the first one is, are you over 59 and a half? If you are over 59 and a half, then you have entered the Roth IRA conversion sweet spot. So in this example, both spouse number 1 and 2 would be in the Roth conversion sweet spot. The second factor to consider is, are you under 70 years old or have you not started taking Social Security yet? If that is the case, if you are under 70 years old or have not started taking Social Security yet, then you may have planning opportunities down here on the Social Security rows as far as when you want to start taking Social Security. You'll be able to scenario test different starting dates in conjunction with all of your other income to determine if there is a beneficial result from accelerating or delaying starting Social Security. And then, of course, the third factor would be, are you under age 73, which is when RMDs begin? And then also to add to that particular point, and something that we will get into in one of the upcoming videos that's going to specifically be on RMDs, is the fact that the start date for RMDs will change to age 75 starting in 2023. So the question is going to be, not only are you under age 73, but also if you get out to 2033 and are still under 75, then your RMD start date will be pushed out an additional 2 years. So we will get into all of the nuances of that when we get to the video specifically on RMDs. All right, next up is our income items, and we're going to start right here with W-2s. Now, when you're doing a projection before the year is over, obviously you won't have your W-2 yet, but you should be able to estimate approximately what you're expecting to be in box 1. In other words, what your salary is less any deferrals. And by deferrals, I mean like to a 401k would be the most common one, to a health savings account could be another one. If you're not completely sure how to estimate it, the best approach would be to get your most recent pay stub. Let's say that pay stub is for a 2-week pay period, and then take the net pay that is shown on the pay stub and multiply that by 26. Right, so a 2-week pay period multiplied by 26 would approximate the whole year. Now, of course, that would assume that you worked in that particular position for the entire year. If you changed positions, if you had different jobs throughout the year, if you had a period where you weren't working throughout the year, then there may be a little bit more involved in annualizing and figuring out what the amount for the year is going to be. Best practice, I wouldn't try to combine multiple jobs onto the same row. Just insert some more rows for W-2s if you happen to have more than one job in a particular year. So going back to that previous example, let's just say that you worked in a position for 6 months. You could take a 2-week pay period and multiply it by 13 to approximate what will be on the W-2 for that 6-month period. Now, for purposes of this video series, we are primarily focusing on the current year tax planning, which is 2024. But for purposes of our broader tax planning, our longer term tax planning, our projections to figure out if we want to do Roth conversions, our projections to get ready for inevitable law changes that will be coming under the Trump administration, probably applicable to 2026 and forward, but they could be retroactively applied to 2025. We'll just have to wait and see how that plays out. But for purposes of all those things, you want to project out as far as you realistically can with all of these various items. So in this base case scenario, when we're talking about W-2s, I have projected income out until an assumed retirement year, and I am assuming that both spouses are going to choose to retire at 65 years old for purposes of this base example. And so for spouse 1, the W-2 income will stop right here in 2028, and then for spouse 2, it will stop in 2029. Okay, so next we're going to move to additional items of income, starting with interest income. I'm going to assume several different accounts for that. I'm going to assume we have interest income coming off of a K1. A K1 is something that you would receive if you have an ownership interest in a partnership or an S corporation. Then we're going to have our non-qualified dividends right here. These are the dividends subject to your ordinary income tax rates. And then we're going to have short-term capital gain right here. Now let's talk about a key difference between all of these investment types of income right here that we just went over versus the W-2 income that we went over earlier. With the W-2 income, it is most likely the case that you're going to have withholding associated with that. It's not all the time. It's not unheard of that somebody could have a W-2 and not have withholding on it, but that's usually for like a part-time or temporary kind of position. In in general, we're going to see withholding attached to this. However, with investment or portfolio income, often you are not going to see any withholding associated with that. So if you project your numbers for these types of income right here, and you have some size, let's say, in this income, and you have not made any estimated tax payments yet during the year, then it's highly likely you will have a Q4 estimated tax payment to be made. And figuring out what our Q4 estimates are going to look like. Q4 estimates are due on January the 15th, 2025. Figuring out what that looks like will be one of the 10 videos in this series. We will focus on what estimated tax payment may be due for Q4. Okay, after that we have our traditional IRA distributions that are not Roth conversions or RMDs. Right now I have that set at 0 for the base case, but we can play around with what happens if we have a number here in one of the future videos. We then have our section for Roth IRA conversions. Again, right now I'm setting that at 0 for the base case in the current year. But choosing to do a Roth conversion is one of those discretionary tax planning decisions that we will look at after we get all of our other income items populated. We want to get all of the non-discretionary income items into the template first so that we can see where we are landing in the brackets, and then we can determine how much Roth conversion we may or may not want to do in the current year. After that, we have our inherited IRAs. For this example, I have set up one where the 10-year RMD period is going to start in the current year, 2024. And remember that with inherited IRAs, if you just take the RMD, meaning the required minimum amount that has to be distributed, then often what will happen in the 10th year is that the final RMD will be a balloon right here. And this has the potential to bump us up pretty high in the brackets, just depending on the amount. And so part of our planning will be, can we smooth out that income and take more than the RMD in current years, with the goal being to maximize lower brackets now and try to stay out of higher brackets down the road. That's the same concept as doing Roth conversions. All right, after that, we're going to have pension and Social Security income. Now again, for the base case, we're going to assume that both spouses are still working. They are not yet retired, and therefore pensions and Social Security are going to be included out here for purposes of our future tax planning. But at least for the base case scenario, we're not going to have anything up here in 2024, but we can play with that later and do some scenario testing for folks that are already taking Social Security or already have pensions that have started. Then we're going to get into the calculation of our RMDs, and one of the 10 videos in this series will be specifically on this, so I'm not going to belabor it right here. And then finally right here, we're going to have a row for the non-taxable portion of any IRA distributions, and we will use this row regardless of whether the distribution is just a regular plain vanilla distribution or if it relates to an RMD. Either way, there can be a non-taxable portion of that IRA distribution. So we will get into that in one of the future videos. And once we are done with all of those items, that makes up our total ordinary income, which is the amount that will be subject to our ordinary income tax rates and brackets. All right, next up on the list are the items that are subject to the preferential long-term capital gain rates. So that's going to include our long-term capital gain from investments, from real property if we have any, from capital gain distributions that come off your 1099 consolidated. Capital gain distributions are considered long-term capital gain regardless of how long you have held the position in the mutual fund. And then of course we're going to have our qualified dividends. So for this example, I'm just going to use $14,000 for long-term capital gain out of our portfolios, $2,000 of capital gain distribution, and $6,000 of qualified dividends. Now, when it comes to making projections into future years, you have a decision to make. When it comes to short-term capital gain up here as well as long-term capital gain, these are the types of income that certainly could be more discretionary in nature, meaning they may not happen every year, and even if they do, they may not happen in consistent amounts. On the other hand, income like capital gain distributions, interest, qualified dividends, those are the types of income where you tend to see a lot more consistency over the years, particularly if the underlying investments remain the same. So for this base case example, I'm choosing to project what I think our short-term capital gain as well as our long-term capital gain will be for the current year. But for the moment, I'm not including any projection into the future for either one of these two categories. Now, how are you going to decide if you should just include the current year's amount or if you should attempt to project it into the future? And the answer to that is most likely just going to be based on your investment behavior or strategy or that of your financial advisor. For example, if you are actively trading securities and you consistently have gain and perhaps that gain is consistently within some kind of a range, that may be an appropriate situation where projecting that kind of income into the future would work. On the other hand, if you are buying and selling securities relatively rarely, meaning you may not have any capital gain in a particular year or it's sporadic or whatever the case may be, then you could either go with the approach of not projecting anything at all, or if you want to be more conservative, you could project some sort of average expectation of what your long-term capital gain would be over time. Now, let me make a distinction regarding what I just said. When we are talking about financial planning and financial projections and projecting our after-tax cash flow into the future and projecting our net worth over time, and we are going to talk about incorporating the tax planning that we are doing right here into a broader financial plan as part of this video series. But when we are talking about all of that, then to be conservative with our projections would mean to project income at the lower end of what is realistically possible and project expenses at the higher end of what is realistically possible, right? To get a conservative answer, you want to project income lower and expenses higher. But right here, I just said to be conservative, you would project more income, in this case, more long-term capital gain. And so the distinction that I want you to remember is that for purposes of the personal tax planning template, we are ultimately projecting the tax due, and tax is an expense. So if we project more income right here, then we are ultimately going to project a higher tax, which would be more conservative. Now, of course, once we project a base case conservative result, in other words, a result that's going to be at the higher end of what is realistically possible, then we're going to incorporate all of our tax planning strategies to try to minimize that. But the point with respect to this item that we're talking about here is if you realistically expect that some level of long-term capital gain will be included in your income every year, even if you can't identify the exact amount, it would be conservative to include something like an average amount that you might expect based on your historical buying and selling patterns. Okay, next up are the other income and adjustment items. And for purposes of the base case, I'm going to leave all of them blank, but we are going to touch on some of these throughout the remaining 9 videos in this series because many of the items in this list have a tax planning component associated with them that could be used to lower your taxes and provide you with additional after-tax cash flow in the current year in 2024. So we will come back to these items when it's time to start doing our scenario testing. Now at this point, we're going to be down to AGI, adjusted gross income, and then after that we have our standard or itemized deductions. Now Now for the base case, we're going to be using the standard deduction, but as we get into the remaining 9 videos, there will be tax planning opportunities associated with some of these itemized deductions up here. In particular, charitable contributions and the bunching strategy. We're also going to get into QCDs, qualified charitable distributions from an IRA. So once again, we're going to start with 0 for the base case on itemized deductions, and then we'll come back to some tax planning strategies. All right, so that's going to bring us down to taxable income. And then for those of you familiar with the personal tax planning template, you know that this section right here is where we perform the ordinary income tax calculation. Going further down the list here, we have our long-term capital gain calculation. We have our self-employment tax calculation, which right now is 0 because we don't have any business income or other income that is subject to self-employment tax. But we will incorporate some of that for purposes of our tax planning in the remaining 9 videos. There is our net investment income tax calculation right there. We have a section to put our tax credits. There are some strategies related to tax credits that you may be able to implement before the year is up if you are interested. And in general, those relate to energy efficient products, either vehicles or for the home. So we can get into some of those later on in the remaining videos as well. Okay, so right now for the base case, we have a total tax of $42,740. And as we often like to do on the channel, we're going to test our calculation against TurboTax. And we're going to use the 2023 edition of TurboTax because as of the making of this video, the 2024 edition still has some modules outstanding. So in order to get the exact calculation, I have expanded the 2023 column right here. Now, for most of you who have been using the personal tax planning template already, your 2023 column should be complete and should agree to your as filed 2023 tax return. But for purposes of this example, I'm going to go ahead and use the 2023 column just to make sure our calculation for 2024 is correct. So I have duplicated the same income and expense items right here in the 2023 column that we just went through in 2024. If we add these two up right here, there's 185 of W-2 income, which agrees to the 185 over here. If I add these 3 items up, there's 6,300 of interest income, which agrees to the 6,300 right there. Now for dividends, remember that the total of this number right here, the non-qualified, plus the total of this number down here, the qualified, which is $13,000, that is what will be on line 3B of the tax return right here. And then just the 6,000 of qualified dividends by itself will be over here on line 3A. The next item, $30,000 of short-term capital gain right here, plus this $14,000 of long-term capital gain right there, plus the $2,000 of capital gain distribution right here gives us $46,000 of capital gain. And that's what agrees to line 7 over here on the tax return. Then back over here, we have our $20,000 of RMD income related to our inherited IRA. We have that over here on line 4B of the tax return. Now, as far as the standard deduction goes, for 2023, it was actually $27,700 for married filing joint. But I'm going to set it equal to the amount for 2024 just so we can get the same total taxable income. So there is our $29,200 right there. So down on this line, we have total taxable income of $241,100, and that agrees to total taxable income over here on line 15, $241,100. So now scrolling all the way to the bottom where the tax is calculated for 2023, because the brackets are slightly different in size. And also I want to note that these are identical now for 2023 and 2024. The only thing that is different is going to be the size of the tax brackets in 2023 versus 2024. And because those tax brackets are slightly different, we're going to get a slightly different answer for the amount of tax calculated between these 2 years. But we will get the same amount for 2023 in this column within the personal tax planning template as is going to be over here in TurboTax. So scrolling all the way down to the bottom of the tax calculation right here for 2023 using the 2023 brackets, the amount of income that we have projected for our 2024 income tax projection purposes is going to be $43,455. And then back over here on TurboTax, if I scroll down here, there is our $43,455 right there. That number, $43,455, includes $771 of net investment income tax, which you can see on the tax planning template right there. And then scrolling back up here, if I sum up all of the ordinary income tax expense within the ordinary income tax brackets, and then I scroll down a little bit further and grab the total long-term capital gain tax right here. That total is the $42,684, which agrees to $42,684 right over here in TurboTax. Okay, so now thinking back about 2024, we have validated our tax calculation. So for our base case scenario, we have calculated tax of $42,740. We've projected all of our income and expense items for the base case in this column right here. And that completes step one of this process, which is to project our base case income tax calculation for 2024. Now that we have the stage set throughout the next 9 videos in this series, we're going to start our tax planning discussion for a whole variety of different scenarios. If you are interested in laying out your 2024 tax projection and going through all of the tax planning that we are going to complete in the next 9 videos, the personal tax planning template is available for purchase in the link in the description below this video on YouTube. Your purchase helps out the channel and gives you a tax planning and analysis tool that you can use for the rest of your life to minimize your taxes and maximize the after-tax cash flow that remains in your family's pocketbook. So it's a win-win for everybody. And in addition, the personal tax planning template will be updated for any and all tax law changes that will be coming our way under the new Trump administration. It will be updated for 2025, 2026, and beyond. There are presumably lots of different things that are going to change, and we are going to incorporate all of them into our scenario testing and our tax planning analysis for many years to come. Okay, that is going to be it for video 1 of this series. Remember that I will be hosting my 2024 tax return preparation class, and it will be held between January the 15th, 2025 through April the 15th, 2025. If you are interested in signing up for that, there is a link in the description below this video on YouTube. Thanks everybody for watching. Hope you enjoyed this video, and I'll see you in part 2.